My next guest warns it might not even be geopolitics or the hard data that will be the next hurdle for stocks. Could be earnings season. Joining me now is Ironsides Macroeconomics Director of Research, Barry Knapp, and it's great to have you here on set. Welcome.
Fun to be here.
So many things. I mean, how are you discounting all of these disparate events, from the Middle East drama to the tariff fight that could be back on the front burner in a couple of weeks' time and everything else going on?
Well, if we start with trade policy, since that's been foremost in the market's mind for the last couple of months, I think the clear message from the markets in April was the impact on final demand and aggregate demand was likely to be much greater than it was ever going to create some persistent price effect. Right. We had a deep inversion of the 2s, 10s break-even curve, meaning, and the same thing happened in April 2022. The idea was if there was any inflation, it was likely to be transitory. But we know what happened to the equity market during April. And so the markets were pretty clear that this was going to be a bigger hit to demand than it would ever, as I said, create an inflationary shock.
At the same time was when I had that dinner with all the supply chain execs, and every single person at that table said the odds of a recession this year were upwards of 90%.
Yeah, well, that was part of the idea, was this would create a big hit to demand. But listen, as you well know, inflation is always and everywhere a fiscal and monetary phenomenon. So let me just leave a couple of stats for the audience.
People don't seem to believe that anymore, by the way. Even though that we've just run this incredible experiment, this natural experiment, said, yeah, no, that is what it is, actually.
Right. So here's just some simple numbers for people to have in their head. M2 growth on an annualized basis is 4.5%. The average since 1960, when they started calculating it, is 6.7%. In early 21, it was 26.7%. So wow. The monetary conditions are decidedly almost the antithesis of what they were in 21. Government spending as a percent of GDP, as Friedman said, don't tell me about the deficit, tell me about government spending. That was 29.75% of GDP in 2021. It's down to 23.4. I've argued all along it needs to get back to 20.3 to ultimately, really create lower inflation over time. But it's 6+ points below where it was in 2021. So the conditions don't exist to be able to pass prices through. And we see that in the retail sales numbers, which...
I totally agree. And by the way, I think we've seen that in the marketing from the last couple of months. You've seen automakers and different groups, Verizon telling consumers, don't worry, we're not going to pass this along. In fact, we're going to offer you price discounts during this difficult time.
I heard Steve say earlier today, were it not for this tariff uncertainty, the Fed would be cutting rates. Sure, they'd be cutting rates. CPI on a 3-month annualized basis is 1%. Wow. Core is 1.7%. It's missed, CPI, PPI have missed 4 months in a row. So we've got, I think there's 4 schools of thought on inflation. There's, Adam Posen, who you had me on with not too long ago, is telling you, okay, it hasn't hit yet, and it's going to create a persistent effect. Then you've got it just hasn't hit yet. Then you've got we've resumed disinflation despite tariffs. And then you've got my school of thought, which is, no, tariffs are actually impairing demand.
They're more disinflationary.
And so it's actually exacerbating that disinflationary effect. It's
like
a bigger
tax hike.
risk.
Yeah.
It is a tax hike. Exactly the issue. You tax import something, you get less of it. You're taxing imports. You're impairing growth. There's fewer dollars in circulation than there was.
Here's the only problem. Intellectually, I agree with you on all of that. And yet we look at GDP, we look at the market, and that seems to be coming out of a playbook of more of what Paul McCulley just described, of this kind of soft landing, of this idea that, final demand is actually surprisingly resilient.
Well, I think that's, of course, you have to look at the whole policy mosaic, right? And so one of the things you and I were talking about a little earlier was an underappreciated aspect of what's happened this week with the Senate's version of the big, beautiful Bill Act.
OB3.
Is making those tax incentives permanent. So when TCJA was passed in 2017 for early 2018, capital spending took off. Now, it went on in structures only for about 6 months because the trade war derailed the positive business confidence shock. But in this case, we took the shock up front. And so now if you make expensing equipment permanent, you make more attractive expensing taxation for factory investment, and you have favorable R&D treatment, we had the weakest CapEx cycle since World War II, other than 58 when Ayn Rand published Atlas Shrugged, last business cycle. So we are on the verge, I think, of a real capital spending boom.